Think $100 isn't enough to start investing? Think again. Today, I'll show you how to grow your money, even if you're starting with just $100. Stick around for detailed tips and strategies that you can apply today. Why start small? Starting small teaches you the ropes without risking a fortune. Plus, consistent investing, no matter the amount, can lead to long-term success thanks to the magic of compound interest. Think of it as planting a seed that grows over time. At the age of 11, Warren Buffett made his first investment by purchasing 3 shares of Citi's Service Preferred stock for himself and his sister. The shares cost $38 each, but the price soon dropped to $27, testing Buffett's patience and resolve. However, he held on, and when the stock price rose to $40, he sold the shares, making a small profit. Shortly afterward, the stock soared to over $200 per share, teaching Buffett a valuable lesson in patience and long-term investing that he carried throughout his legendary career. Someone is sitting in the shade today because someone planted a tree a long time ago. This story and quote emphasize the importance of starting small, staying patient, and focusing on long-term growth. Before diving in, ask yourself, why are you investing? Is it for retirement, a big purchase, or simply to grow your wealth? Having a clear goal will guide your decisions and help you stay motivated. Your investment goals play a huge role in determining the right strategy. Let's break it down. Short-term goals, which are within 1 to 5 years. If you're saving for something like a house down payment, safety is key. Options like high-yield savings accounts, CDs, or short-term bonds help protect your money. Medium-term goals, which are within 5 to 10 years. For goals like building a college fund, balance is essential. Try balanced mutual funds or index funds that mix growth and stability. Long-term goals, which are 10 years and beyond. Big dreams like retirement or building wealth allow you to take on more risk. Stocks, ETFs, and even real estate can help your money grow over time. Always match your strategy with your timeline. For short-term needs, focus on preserving your Pick an investment platform. Look for apps with low fees, user-friendly interfaces, and no minimum deposit requirements. Popular choices include Robinhood, Webull, or eToro. Most of these allow you to start with as little as $1. When choosing an investment platform, security should be a top priority. Look for features like two-factor authentication to protect your account from unauthorized access. It's a simple, yet powerful way to safeguard your investments. Don't stop there. Take time to research user reviews. Platforms with high ratings and positive feedback often signal reliability, while consistent complaints may be a red flag. Remember, your money deserves a secure and trustworthy home. Taking these steps ensures you're investing safely and confidently. At step 3, you need to decide on an investment type. The first option is stocks. With $100, you can invest in fractional shares of top companies. Love Apple or Tesla? Start small, but think big. Fractional shares make it easy for anyone to own a piece of their favorite companies. Next are ETFs, or exchange-traded funds. ETFs are great for beginners. They spread your money across multiple assets, reducing risk while giving you exposure to the market. Popular ETFs include Vanguard's VOO and SPY, which track the S&P 500. Next are index funds. Index funds track the market, like the S&P 500, offering diversification and steady growth over time. They're also cost-effective with low expense ratios. Then there are cryptocurrencies. Interested in crypto? Platforms like Coinbase and Binance allow you to invest in Bitcoin, Ethereum, and more with as little as $10. But remember, crypto is highly volatile. Only invest what you can afford to lose. Set it and forget it. Automation ensures you're consistently investing no matter what. Plus, many platforms let you automate investments so you don't have to remember to do it manually. Let's face it, investing can be stressful. When the markets are volatile or there's news that makes you nervous, it's easy to let emotions take control. You might think about pulling your money out of the market or shifting strategies because of fear or greed. But here's the thing. Emotional decisions are often the worst ones in investing. That's where automation comes in. Automation, in the form of robo-advisors, can take that emotional aspect out of the equation. Robo-advisors are tools that use algorithms to automatically manage and adjust your investment portfolio. They help you stick to your long-term goals and take out the guesswork. These tools work by first assessing your goals, risk tolerance, and time horizon. Then, they automatically adjust your investments based on these parameters. For example, if you're planning for retirement in 30 years, a robo-advisor might help you build a diversified portfolio that gradually shifts from high-risk investments like stocks to more stable options like bonds as you get closer to your target date. Remember, in the world of investing, emotions can be your worst enemy. But with automation, you can make smarter, more disciplined decisions that lead you closer to financial freedom. Do's and don'ts. Research the platform and the investment. Diversify to spread out risk. Invest regularly, even if it's just $10 a month. And don't panic sell during market dips. Invest money you might need in the short term. Ignore fees. Even small fees add up. Let's say the market dips. It's easy to panic and sell your investments to avoid losing more. But here's the problem. Selling in fear locks in your losses, and you miss out on the potential market recovery. For example, let's say you panic sell when the market drops by 10%. If you stay out and wait for the market to recover, you miss the chance to benefit when it bounces back. Historically, markets always recover over time, and investors who stay invested tend to see better long-term returns. Here's a better approach. Automated tools like robo-advisors help you stay disciplined even during market dips by automatically adjusting your portfolio based on your goals and risk tolerance, not emotions. Remember, long-term success comes from staying invested, not reacting to every market movement. This is an example. Let's say you invest $100 in an ETF with a 10% annual return. In 20 years, that $100 could grow to nearly $700. Now imagine adding $100 every month. You'd have over $75,000 in 20 years. Ready to start? Hit that like button if this inspired you, and subscribe for more tips on growing your money. Your $100 could be the start of something big. Share your investment goals in the comments. Let's take this journey together.